Welcome back. You're watching The Money Show on ET. Now, just before the break, of course, we were having a conversation on arbitrage funds, the kind of inflows that we have seen in this fund category, and how as investors you can position yourself in arbitrage funds from a holistic portfolio perspective. Well, now let's introduce on the show the fund manager of one arbitrage fund that has been among the top performers on a year-to-date basis, on a one-year basis as well. This fund has managed to deliver a little under 5%. So let's welcome on the show Sailesh, Jain, fund manager for Tata Mutual Fund and of course Tata's Arbitrage Fund. Thanks so much, Mr. Jain, for taking our time and joining us to talk about the Tata Arbitrage Mutual Fund. Let's start by talking about what exactly this fund does, the basics of it, because I suppose arbitrage fund may be something that's still a little new for retail investors. So you could start by introducing the fund. Where does it invest? What does it strive to achieve for its unit holders?
Yeah, hi. First of all, good evening, Mubina, and good evening, all viewers. Just start with, as far as arbitrage fund is concerned, arbitrage fund is an equity-oriented fund which generate returns from the mispricing of the assets, which is typically the cash and the future segment. The trade involves a simultaneous purchase of the cash leg and selling of the future leg at the same time. Just to highlight that every trade done in the cash segment is completely hedged with the future segment, which means that there is no price risk on this fund. Since they are equity fund, 65% of or more is invested into the equity and equity related instruments. A portion of it goes into the margin money, and the rest is kept in the cash, which is like the TREPS.
Okay. Now, the last few months, I'm sure you must have as well observed that the last few months, the AMFI data has been showing that there's been continuous net inflows in this category. Even when we have seen months of, flows slowing down for equities or turning negative for debt funds, I think this segment has continuously seen a lot of popularity among investors. Why do you think, what makes this sector a hot buy, this category rather a hot buy?
So yes, you're right. You're right in this. So arbitrage funds, if you see, are compared to liquid funds as far as the risk and the reward is concerned. Bulk of the investment which we have seen in this category in last few months has been due to the superior linear return which we have observed in this category. If you see last 6 months, average is around close to around 5%, which is like around 150 basis point or so higher than the liquid fund on a post-tax basis. My belief is that we will continue to see a 50 to 100 basis point outperformance of this fund return versus a liquid fund. If an investment horizon is for investment horizon is for around 6 months or so. Having said that, I believe that a part of a portfolio should be into the arbitrage fund. However, re-emphasizing the fact that every fund has its own advantages, and as far as liquid fund is concerned, and no funds can replace each other fund completely.
Okay, so what arbitrage funds essentially are used for is taking advantage of the mispricing. So it sounds, if you just simply have to put it, you buy at a certain point, and then where you find a mispricing opportunity where the security is available at a higher price, you sell it over there. So from the sounds of it, it looks like almost a zero risk kind of fund. Because you since you're looking for opportunities, it's guaranteed of sorts that you're going to get it at that higher price that you're looking at when you want to book your profit, because only then would you book your profit. Am I right in reading into this? And if you could also throw some light on how should investors look at the risk of an arbitrage fund?
So yes, Mubina, you're right. So yes, as far as risk is concerned, because this is an hedged product, which means that every trade which is initiated in the cash segment is completely hedged with the future segment. There is no price risk on this fund. So yes, this is a very low risk product. But as you said that there are ways when you can realize your profit. The realization can happen on the expiry day or pre-expiry day. This is because of the demand and the supply mismatch which may happen, which may actually move the spread into premium and into discount. Those opportunity actually enhances the return. So yes, if you put it in a very simple term, because every position is completely hedged right from the inception, this is a very low risk fund as far as the risk is concerned. And the return generated are basically from the mispricing, as you said. Basically, the difference between the cash and the future segment.
All right. How do you split, the money that you owe? And what's the SEBI rule as well? Actually, if you could cover that in your arbitrage fund, how much have you put in equities, and how much is also in the fixed income market? If you could shed light on that.
So so you need to understand two things. One, that this fund, so let me put it very simply, that if you have invested 100 rupees in this fund, at least as far as I am concerned, 65% plus, which is obviously the SEBI rule or the equity or rule for the equity oriented funds, you need to invest at least 65% of your money into equity and equity related instruments. So that's the norm. For us, if you put 100 rupees in our fund, or the first 65% to 68%, at the moment I am still invested like a 69% into an equity. But for an easier purpose, let's take 65 to 68% of your money will go into the equity and equity related instrument. Close to 22 to 24% of the money will go into the margin instruments, which can typically be the GSEC, T-bills, mutual fund units, or cash. So that roughly will make to close to, and the balance of the amount will be kept as a cash, which I mean in TREPs. That's the overnight funds. So this is just to take care of the mark to market. Any extra money, if you believe that you don't need to keep so much of the money cash, which a fund manager decides, can go into debt instruments, which obviously the percentage of that number can change. So, but for a broader perspective, 65 to 68% is basically, that's the 65% the bare minimum to be kept in the equity. And depending on the opportunity, you can go up to 65 to 68% to 70%, depending on the fund manager and the opportunity in the market.
Fair enough. Okay. Now, many investors, and we've been getting a lot of questions as well in this regard. Many investors, we've been, talking about how it's good to, at least prior to this last 1 year, but we've been talking about how instead of leaving money in a savings account where you earn 2 to 3%, you put it in a liquid fund where you get that percent or two extra, plus you get obviously tax benefits as well, especially if your amount is high in a savings account. And then you start investing in equity mutual funds via an STP, etc. Now liquid fund returns had slowed down recently. It's picked up again, but it had slowed down before that. So many started looking at arbitrage funds. So how would you compare liquid and arbitrage funds? I think the key distinguishing point you already mentioned, that 65% in equities.
This category is comparable to liquid funds as far as risk and reward is concerned. People investing into the liquid funds, rather a part of their investment which they don't need for 6 months, definitely can be invested into this category in a bid to achieve like a 50 to 100 basis point higher than the liquid fund. This category has more linearity in return, and it does not have the risk burdening to the debt funds in specific. In fact, even the money lying into the saving bank can definitely be invested into the arbitrage category as such, because the risk, as I have told earlier, are potentially very, very low, and the return generating capability is actually higher than the liquid funds, around 50 to 100 basis point on the post-tax basis. Reason being very simple, this is an equity oriented fund where the taxation is on the long term and the short term, whereas the debt funds are taxed on the marginal tax rate. So.
Okay. All right, understood. Well, I think so far the whole of 2021 has been a pretty good ride for arbitrage funds, and I think that really is the reason why we are seeing that unusual amount of interest too and activity from investors in arbitrage funds. These last few months we've seen a tremendous amount of money come in, and I think investors too seem to be recognizing it. When is it the best time, Sailesh, for arbitrage funds to make money? Is it when you see more volatility in the markets, there's expectation of more volatility, when investors should really look at this category? Just want to understand, from the point of view of right now, what is the opportunity you see in arbitrage?
So yes, so as far as an arbitrage fund is concerned, two markets actually work beautifully well for this fund. One, if it's a bullish market, and one, it's a volatile market in a bullish period. So what can really not work is a bearish phase where you see a correction of like a 20% on Nifty or a 25% on correction on the Nifty, and if it's a prolonged correction. But in general terms, a value correction of 5 to 7% is actually good for the arbitrage fund because volatility creeps in, which actually gives you an early exit than the expiry. As I said earlier, that your money can be realized earlier than the expiry. So typically, a bull market, a bullishly volatile market, is a good time for an arbitrage fund to invest in. But just putting a caveat to it that your investment ideally should be for 6 months and beyond.
Yeah, that was actually going to be my next question, and that's the time horizon that investors should keep in their mind when they are investing in arbitrage funds. 6 months to 1 year ideally should be the time horizon that you should keep in mind. Now, of course, 65% of the portfolio is equities, and you have the clear intent, of how you essentially are. In a way, it's like a hedge for the equity stocks as well that you've purchased for the fund. So how do you go about picking the stocks then, Mr. Jain? What do you look at in terms of the the pedigree, the volume, etc. of the stock that you pick for the fund?
So yes, so just putting in perspective, I mean, as you said in the earlier, we have been the best performing fund for a while now. We are ranked like number one on a 6-month basis, 1 year basis, 2 year basis. So we have a very specific portfolio approach in managing this fund. Obviously, what you said are one of the criteria, like the volume criteria is also a criteria when we look to invest. But we define a specific allocation with respect to the market capitalization, that is the large cap, small cap, and the mid cap, that is the investment into this market capitalization. We have a specific allocation to individual sector and the stock itself based on their assumed volatility and the rollover or the carry forward potential what they have in the stock. So we define those things very clearly while investing into a stock, a sector, or a market cap. That's one. Second part is obviously dividends play a very important role of returns to this fund, and we run a very iterative model on the dividends. We actually tries to predict the dividend of an individual stock and the nuances around it. So this definitely helps us versus our peers. So this is what has been working well for us from the last since we have launched till now.
Well, Sailesh, I really appreciate you giving us your time today on ET Now to just talk about your fund to your unit holders, your prospective unit holders as well. I'm sure they've got a good understanding of how the fund works, how the category as well works. Thanks so much for taking our time.
Thanks everyone. Thanks, ET Now.